There's a secret about options trading that most traders don't realize, and that is that options traders actually love volatile markets because they have the opportunity to make so much more money with the same or even less risk. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our proprietary trading desk are trained to understand the dynamics of options pricing in volatile markets and the incredible opportunities that certain options trading strategies represent. In today's video, we're going to be teaching you why a very simple trading strategy gets exponentially better to trade in a volatile market than in a mild market. So if that sounds like something you'd like to add to your playbook, then stick around because I think you're going to find this compelling. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so it's not exactly a secret that we're in a very volatile market with inflation running rampant worldwide and the Federal Reserve scrambling to get the situation under control, even if it means pushing the world into a recession to do so. And so, along with that kind of aggressive tightening of monetary policy comes much more volatility in the financial markets. And one of the very best measures of this volatility is the VIX Index, which measures the amount of price volatility built into index options based on the S&P 500 index. And as you can see, that index started the year somewhat mildly down at 16.6. And due to the Fed's increasing hawkishness and other geopolitical factors, the VIX is up over 83% so far this year, up over a reading of 29 as of this moment, which is an abnormally high reading, signifying that the market believes that for the near future anyway, market prices will continue to be volatile. Now, before we get into the strategy that benefits enormously from this kind of market volatility, I wanted to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. Okay, so in order to explain how this strategy works, we need to make sure that everyone watching this video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. The best way to understand index options is to think of them as bets. What is known as a call option pays off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call's strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless as the index didn't close above 40.75, so the call seller just pockets the premium, and the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75, but the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. All right, with that said, let's head back in time to one of the very least volatile periods in market history, and that is October of 2017, when the market was grinding upwards, which almost always coincides with the VIX Index falling because periods of slow grinding upward movements generally present much less in the way of dramatic lurching one-day moves like we're seeing almost daily these days. And so let's say that on October 25th, 2017, first thing in the morning, a trader, for whatever reason, was bearish that day. And he thought that the SPX index, which had opened up at 2567.20, down a small amount, would continue to sell off during the day. Well, in that case, then he could have sold 10 of the calls expiring that day with a strike price closest to the opening price of 2567.20, which were the 2565 calls. And he in turn could have bought 10 of the 2570 calls expiring that same day. And when the trader does that, he's entering into what options traders refer to as a call credit spread. Now, why would we call this a bearish strategy? Well, let's examine it a little bit. You see, when a trader sells those 2565 calls, he receives the market price of $3.85. And remember that for each point above the strike price of 2565, the trader would owe $100 per point, and he sold 10 of them. So multiplying it all out, he would have received $3,850 for selling those 10 calls. And then for protection, he turns around and buys 10 of the 2570 calls, which would have a cost of $1.35 that day. And so as a result, as you can see from the calculations, he would have netted positive cash flow of $2,500. Now, how much he receives is really important here because that also determines the risk of the trade. And why do I say that? Well, think about it. Let's say that at the end of the day, that the trader who, remember, sold the 2565s and bought the 2570s and received $2,500 for the trade in totality, let's say at the end of the day, the index closed at 2583. Well, in that case, the 2570s would pay the trader $13,000, as you can see from the calculation, because you'd subtract 2583 from 2570 to calculate the payout amount under those 2570 calls, and you multiply that by 100, because remember, the trader receives $100 per point for each call he bought, and he bought 10 of them. So that comes to $13,000. But by that same logic, he has to pay out $18,000 on that 2565 call that he sold, as you can see from the calculation, because the market closed 18 points higher than the 2565s. And so that's a gross loss of $5,000. However, remember, he collected $2,500 up front, so he actually only loses $2,500 on the trade because obviously you include in the profit calculation the cash you got for taking the trade in the first place. And very importantly, this is true for any price above 2570 because no matter how high the index were to close, the increase in the payout under the long calls would offset dollar for dollar the increase in the payout for the short calls. So in other words, once the index closes above 2570, the loss can never get any worse because the protection has kicked in fully at that point and protects the loss from getting any larger. Now, as it happens, the index closed at 2557.15 that day, and because those options expired on that day, we can calculate the final value of the trade because as you can see, both the 2570 calls that we were long and the 2565 calls that we were short, both of them expired worthless because the index closed below their strike prices, and calls only pay off if the index closes above their strike prices. And so instead, the trader just pockets the premium he first received for a profit of $2,500 on the trade. So that was a winning trade with a worst case scenario loss of $2,500 and a maximum profit of $2,500 also. Now, with that trade in mind, let's move to this past week in the midst of this really high volatility market with the very high VIX Index reading, as we mentioned earlier. And as you can see, the index opened at 3769 that day, having been in a sell-off all year. And so if on that day we did a pretty much apples for apples trade, picking the closest calls to the opening price, which were the 3770s, and selling 23 of those, and in turn buying 23 of the calls 5 points above those at 3770, just like we did in the previous example, we have again entered into a call credit spread that expires that day. And I say this is apples for apples because the trade involved the two closest strike prices to the SPX opening price. But you'll notice this time we sold 23 of them instead of the 10 in that 2017 example. But I'm still calling this an apples for apples trade, and let me explain why. You see, when you sell 23 of these credit spreads, as you can see from the same kind of calculation we made before, you received $56,925 for the 23 3770s you sold, and you turn around and pay out $47,840 for those 3775 protective calls. and so you net out $9,085 in cash. However, this time, if we look at what happens in the case of a loss, for example, if SPX were to close at 37.92, then just like we calculated in 2017 example, you'd get 39.1 for the 37.75 calls you bought, but you'd pay out 50,600 for the calls you sold, netting you a gross loss of 11.5. But remember, you initially collected $9,085. So the true net loss of the trade is 24.15. And just as we discussed in the 2017 example, that same loss is the maximum loss that could ever have happened on this trade, because for every closing price above 37.75, the amount by which you pay out under the 37.70 calls is offset point for point by the amount you're getting from the 37.75 calls, freezing the worst case loss at 24.15. Well, as it turns out, the index closed at 37.35.48 that day, resulting in a gain of the entire cash flow of 90.85, because again, the index closed below both the short and long calls, which therefore both expired worthless. And so what I want you to focus on is the comparison of these two trades. And as you can see, both trades were subject to about the same worst case scenario, about $2,500. But look at the difference in the potential of the rewards from a low volatility time period to a high volatility time period. It's massive. And the reason for that is that in high volatility times, you're being paid so much options premium that the maximum loss, which you understand by now is dictated by how far apart the short and long options are from each other, that maximum loss is greatly reduced by the premium you bring in, which allows you to trade with much greater size and still have the same worst case scenario. And in this example, the reward has increased by 363% purely because of the volatility environment. And so what I'd like you to take away from today's video is that there's edge in waiting for the right volatility environment for the options trade that you're making. And that may differ from one strategy to another, but there are potentially huge benefits to waiting for just the right environment for your strategy, a concept that professional traders know well and use to their benefit. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it. Any questions?
Yeah.
Yes.
So what physically happens, like let's say you sold the 25.65s, you bought the 25.70s.
Yeah.
What happens in between those two prices? Because you have this does that make sense?
All right, who knows the answer? What happens, let's say 25.65, 25.70, suppose the market closed at 25.68, 3 points above the short, but below the long. Yeah. What happens?
So the ones you bought are worthless. So you lost all the premium on those.
Correct.
And then you only
lose the ones you sold.
Yeah, but you only lose the premium between, or you only.
Or you're paying off. You're paying off.
Yeah. The only between that and then the price that it closed at. So it hasn't.
And then you
reached your
subtract
max
from
yet.
that the
How's
premium.
that calculated then?
So you're taking a
$100 a point.
Yeah.
Oh, okay. So let's
price minus your
So
price.
here, we'll give you an
By
example.
0.1
Here's a quiz. You got $400 for the credit. The market closed above the long call.
I got $400 for the credit, you're saying?
Yeah, you received $400 for the credit.
Oh,
It's 5 points apart, and the market closed above the long call. Did you make money, lose money, and how much?
I lost 100.
Excellent. Okay. Now, you've received 400. Market closed at 25.68, 3 points above the short strike, but below the long strike. Did you make money or lose money?
Made 100.
You made 100,
Yeah.
even though your short strike was what they call violated, meaning it was, it was
still
paying
got the
off.
premium initially.
Yeah, think of it like an insurance policy. You
Okay.
paid a claim, but the claim amount was smaller than the premium you got that you
it.
paid the insurance company.
So it's your max loss is the distance from the two.
That's right.
Okay.
And so
then once it keeps going higher, then that's just fall. That's like this
so,
little thing.
so in a high volatility environment, you're getting more premium for everything because the market has to price in the ATRs these days are way bigger than they normally are, right? So the market's pricing in huge amounts for these index options because they're the insurance company. They got to cover their costs, and so so you can still have your short strike violated and still make money on the trade.
Because
That's not, you'd rather not, because it's like
Yeah.
risky bit, but if it happens, you have this like little gap. The gap is what's created by the credit you receive. You see? So so in a high vol environment, you're just getting paid a lot more. Your risk reward basically is being altered by that, and was a ridiculously good case of it. I mean, you do that trade all day, right? Because you're going to make 400 for every 100 you lose.
Mm-hmm.
Now, I mean, but it's risky. You could still lose 100, but your reward is much greater. Any other questions?
Oh, sorry. What's the maximum you can make? I mean, that's good.
The maximum is the premium you get.
Okay, so you're limited in terms of gains.
Yeah, exactly.
Okay.
So this game has think of it this way. It's the only trade where your stop is built into the trade. It's literally part of the trade. It can't get any worse than a certain number, right? But yeah, you're paying for that. And what you pay for having that stop built in from the second you put the trade
Is
in
kind of
is that there's
Yeah.
a cap on the reward.
That's fine.
All right. So that's why yes.
Just a quick question for credit spreads. Are there certain scenarios where you can potentially lose more than your max loss? I've heard a few instances where, say, the price on expiration day can close between like the two strikes, and like one will get exercised, and then you could end up taking more than your max loss on the trade. I don't know if that was true or.
Oh, that's interesting. In other words, one gets exercised
Yeah, so one gets exercised and then
the other
you
one
have-
dies, and now there's a rally.
Or then after hours, right? So it's like one gets exercised and
Yeah.
then, did I say earnings
Well,
shoots up?
that can only happen on equity options,
Yeah.
right? It couldn't happen on an index option.
Mhm.
So that whole issue goes away for this trade. That's one of the reasons I tend to not do credit spreads on stocks, because there's a couple scenarios like that I just don't want to get involved in,
Or just
that I
close it
can't
up
control.
before expiration,
Yeah,
yeah.
well, that's right. That when you're at 3:59 p.m. and you're in danger of one of your options getting assigned, which would happen, it really can happen at any point after you sell it, by the way. It's what they call American style options. So when you sell a call, you sell a put, that can be assigned at any point while that option is still alive, as long as you're still short that position, right? But it doesn't make any sense for it to be executed except in certain circumstances. Most of the time, stocks are going to get assigned at expiration.
And
The
that's
vast-
because there's extrinsic value built into
Correct,
to the option.
exactly.
That
So
makes sense.
it doesn't make economic sense to buy it back. But what you should do in a case like that is, before expiration, just close it. Then you almost definitely will not get assigned, and that whole issue goes away. Then there really can't be a max loss worse. But on index options, it's impossible. What you're saying is impossible. Yeah. Now, I mean, I've heard about people who don't understand what the hell they're doing and actually paying more than the maximum possible loss on a trade. And believe me, every trader out there on the other side of that is going to take your money. They're not going to tell you you're making a mistake, right? So, yeah, that's that. Good question, though. Anything else?
Yeah, I have a question.
Yeah.
So in this example, we kind of do an at-the-money credit spread. Is there any benefit to, since we're in a more volatile environment, to go a little bit further out of the money, just
There-
because the market's moving along?
Here's the best way to think of it. Any options question, for every benefit you get, you're getting some detriment. So, well, let's put it out to the group. What's the detriment of moving the option out farther away from, moving the credit spread farther from the at the money? At the money means where the market was trading when you put it on. What would be the downside to doing that? What's the upside? What's the downside?
You get less premium.
You get less premium. That's the downside of doing it. And does everyone understand why you're going to get less premium? There's less risk of that trade.
Getting hit.
The goal of these trades is for both options to expire worthless. That should, I think it's pretty obvious by now, right? You want them both to expire worthless. So in order to achieve that, the farther away you are from the market, the more likely that is to happen, obviously, right? The problem is the rest of the market knows that too. So they don't charge you very much, and you can't charge very much for the short. This trade's really about the short option. That's where you're making your money, and that's where all your risk is. The long option is really just to control how bad it can get. Okay, so the farther away, the less premium you're going to get. However, the trade's probability of making a profit goes what? Up, down, sideways?
Up.
Goes up, right? So you're trading off probability for income. And that's a really good understanding. That's a really good thing to take away from today's meeting. The less risky an options trade is, the more probable you'll make money on it, and the less you'll make. Now, so the question is, why would you not always go as far as possible from the money? And the answer is because the farther you go away, if you're going to get $400 for that trade I just showed you, right? If you went 50 points farther away, remember it's a one-day trade, okay? 50 points farther away, if you get $15, I'd be surprised, okay? You might get $10 on expiration day. You go out a year, you'll get paid really well for that, but you one day, there's no time left, right? For a big move. Of course, it could happen. So you get $15 for a $500 exposure per lot. Think about it, right? That sucks. But you know what your probability of profit on that trade is? Like 98%. So believe me, if you have one takeaway from today's meeting, it's this. Never do that trade that I just talked about, that $15 trade, because you will lose money long-term doing things like that. You add up all the trades where you have a 99% probability of profit, and that one time you lose on it will take every single penny you made before that and some from you. And you'll get fired too, because believe me, prop firms don't like people taking super high risks and getting almost nothing for it, right? That's like a real no-no. If you're going to take a lot of risk, fine, get paid for it. So you don't want to be, I used to run an insurance company, so a lot of my thinking is informed by that experience, because insurance actually and options are actually very similar concepts, if you think about it. And so in the insurance company, you could write, if you're Exxon or you're some major corporation, right? Do you know how much insurance they buy to cover their liabilities of people getting hurt with their stuff? A company like Exxon probably has $5 billion worth of insurance, maybe more, okay, to cover their liability should somebody get hurt through their product, whatever their product is, right? They buy billions of dollars of coverage, right? So wouldn't you rather be the insurance company up there in the top 100 million of coverage on a $5 billion placement than the guy below? Because the way the coverage works is it's done in layers. So there's some guys who are at the lowest levels. The first losses go to them. The second losses go to them. And then the highest losses go to the guys in the top tier, right, in that top number. Well, those guys hardly get paid anything for being all the way. They're so far from loss that they get this dinky little premiums. The guys down there get the big premiums. The smart insurance companies actually want to write lower. Even though they're much more likely to get risk, they're getting paid so well for it that the risk-reward trade-offs are much, much better. You know who are the companies who do these top layers? They're guys who are just about to go out of business. They're so weak financially that they just keep taking these crazy bets that they get paid for it. They get paid really nicely, and they're winning a lot, but they're taking such a massive risk compared to the reward they're getting that they end up getting hit eventually, because these companies are buying this insurance for a reason. They're buying $5 billion because every once in a while there's going to be a $5 billion claim. You know, there was something, all you guys are too young for this, but there was something called the Exxon Valdez. There was this big oil spill in, I think it was in Alaska or something. Alaska? Okay, so you're not too young, right? Or you read history, right? Okay, it was up in Alaska, right? The Exxon Valdez. It was this huge oil spill. It was like a multi-billion-dollar claim against Exxon, right? So that's going to happen. And then all those little dinky $5,000 premiums you got for taking a $100 million exposure are not going to look very good at that moment, right? That's the same exact principle in trading in general and with options specifically.
Another question?
Yeah.
How is this like? I mean, I know it is different, but what is like? Let's just like pros and cons
Yeah.
in terms of like longing equity and like longing a put like against that.
What's your question again?
Like, let's say you want to. I mean, for this case, it's bearish. So like, let's say you short equity and long a put to protect your downside.
Well, yeah, of course, you're going to pay for that put, right?
Yeah, you're longing.
So, right. So
you're
that's going to.
shorting equity, longing.
So you're setting up a hedge essentially,
I guess, yeah.
right? Yeah. People do that around here all the time.
I'm wondering if like how I'm just not fully understanding the difference. Like, so, but in that situation, your risk isn't capped, right? And then the way that this one would be.
They're short.
You would have
You're
to go
capped
with-
at no. There's no cap on a short stock theoretically, right? Because you can go to infinity, the stock, right? The put. So if you, well, first of all, you wouldn't buy a put.
I meant to buy a call. My bad.
Yeah, right.
You're shorting here. You're buying a call here.
Well,
Shorting
if you
equity.
have that call completely covering, for every call represents 100 shares, right?
Mm-hmm.
So if you have a call that completely covers the number of shares you have short, divided by 100, right?
Yeah.
Okay. Then you've hedged the position, but you may have trouble making money on that trade because the cost of the call
It's so high that
is so high that it negates. It'll go out worthless, and then even though you've made money on the stock because the stock sold off,
You're not making
you're
money.
not making any money in totality.
So
So you
what-
have to. Basically, what people do is they don't cover their entire position they cover a portion of it with calls.
Oh, I see.
Another
See.
thing about this is
And they would-
you're short volatile, so typically you'll do this in a higher volatility environment. And like in this too, like the stock can
You're
consolidate.
saying for this credit spread?
Yeah, for the credit spread. And like the stock can consolidate for the credit spread, but you can still make money by
Right.
expiration, unlike if you're short equity and long a call.
Right. Well,
So
that's
I
the
guess
other.
I'm
We didn't
wondering-
even talk about that in this video, but you understand if the stock opened and closed at the same price,
You still make money.
You
Yeah.
you make all your money.
If
Yeah.
you're positive, you're making money.
That makes sense. I'm wondering, so
Right.
when would what I just said be more advantageous to?
You're expecting a
Something
big
like this.
move, right?
Would it be prior to a big move before like IV spiked or something?
Yeah.
To do something like this.
Not
to
this
do
one,
that,
the
to
one I
do-
was talking about. Equity and-
Well, the one you're talking about, you want to do when the volatility is low. Anytime you're buying an option, you want to buy it when what they call the implied volatility of the option, which is the price, the IV of it, is low.
Okay.
You want to buy low, sell high, right? So you always want to buy. Now, you can't always manage that. Sometimes you're in a really high risk grade. The whole market knows it's volatile. The calls are going to be priced high, but you still may need the hedge. I mean, I always ask that. I am not an equity trader. I'm a pure options trader, and I don't really day trade with options. I do stuff like this, and I do spreads basically. And I always ask them, well, if you're going to hedge, why not just sell less shares? If in that scenario, why not just sell less shares, right? But
I guess the possibility of making money on both.
you can't make. Well, it depends on where the call is.
I'm saying a little bit out of the money call.
Buying or selling?
So let's just do this. So buying a little bit out of the money,
Yeah.
and I guess you're holding your short through that, and then if it does come back down.
If it comes back down, you'll lose money on the call. So you can't make money. You can't make money on both if you're short stock and long call.
Oh, okay.
So Stephen, and another thing, that is more of a directional trade. This necessarily does
Yeah,
not need to
isn't-
be a directional trade.
This is a neutral to non-directional trade.
Oh,
Has
I
anybody
thought
ever
it
heard
was
of
bearish tilted, but maybe I'm wrong.
Yeah, delta.
I'm sorry.
Delta negative, but you can still make money if the stock consolidates, or you could even. You really just don't want it above the
Short strike. Yeah. The bearish,
Okay.
this is a bearish or neutral trade. You don't care if if the index literally doesn't move. In fact, I always talk about there's only one scenario where you can lose on this trade. Let's say the market goes down a lot, you'll make all your money, right? The market goes down a little, you make all your money. The market doesn't move at all, you make all your money. The market moves up into your short strike. If it doesn't go too far, you'll still make money because you're collecting more premium than the only scenario where you lose is where you were completely wrong and it went strongly against your guess, right? Well, you got to lose in some scenario,
Yeah.
right? So it's not bad odds. But the counter to that is that the reward is nowhere near. If you're just shorting the shares,
Yeah.
then you're going to make a lot more money.
So this is like higher win rate and a little bit lower.
Probably a lot lower.
Reward.
So like
Reward per
your
trade.
scenario, you can lose on both.
Yeah.
Right? You could lose
Yeah.
if it doesn't
Right.
go down, and then
The-
you can
yeah.
also lose the premium.
The other thing is exactly the call premium has, right, you could lose if the call's above where the market is and you short it at the market. Obviously you're going to short the market, right?
Mm-hmm.
And the call's above that, you can be in a scenario where you lose on both, because the call will dissipate to nothing if it never reaches strike price, and the shares will, you're short, so you wanted to go down, but they went up.
But you can sell your calls before the day. Right?
You can,
Yeah,
but you're gonna lose. Well, it depends on what happened. Here's
Whatever.
what can happen.
Yeah.
People don't realize this. You can buy a call, the stock can go up, and you can lose all your money.
Yeah.
Because depending on where the call is, and the passage of time is a major player in this situation, right? So with the passage of time, you're gonna lose. You can. So people are, gee, I bought a call. Damn, stock went up. How can I make money with options? And they don't understand. There's this thing called time decay, or theta, and if you're long an option, time decay is your enemy. If you're short an option, time decay is your friend.
Got it.
So anyway, anything else?
Oh, one last thing.
Sure.
Sorry. If you are short an option, can you get out of that obligation before?
Yeah, you buy it back.
Okay. Okay.
Yeah, it's, I guess, set like shares, right?
Like I'm saying, if time decay, you're starting to realize, oh, this might.
Well, time decay would be working for you if you're short that option. So if it's losing,
No, yeah.
let's say the market's moving against your short,
Quickly, yeah.
right? Okay. Well, then you of course buy it back.
Okay.
So your stop has to be as to the options price, not the stock price. People get mixed up about that. You got it, right? You paid $1 for the option, and if your stop is $1.50,
Mhm.
it's the $1.50 on the option, not on the movement of the stock itself.
And also, I'm assuming that like any premium selling strategy needs to be hedged, right? There's no naked put selling or naked call selling.
This firm did not allow naked
Yeah.
options. Now, covered call is not a naked option.
Right, if you own the equity.
If you have the equity, then it's covered. So
So these are a lot like credit spread.
This is a credit.
this is credit spread.
Yeah.
Covered calls are very similar to credit spreads.
Okay.
What about like a cash secured put?
Cash secured put is a naked put. It's an uncovered put. That would not be something you could do here.
Or is-
Do you have like an ideal theta, or like a theta that's like your, I don't know, you have like the most success in? Like for yourself?
Well, what do you mean by
Or
theta?
just like just like with your time decay, like oh, I do better like a week out. Or 2
Oh, I
weeks
see.
out,
Okay,
or-
so you're saying days till expiration is kind of what you're asking, right?
Yeah.
Well,
Before-
I'm a real long. My typical trade's about a month, 2 months. But I do real long because I'm so busy. I don't really have time to mess with it. And the longer the trade is, the less you have to fuss with it. Basically, there's reasons which take a long time to explain. But anyway, the shorter options are you make your money much faster and you lose your money much faster. Right? They're much more dangerous. They have this principle called. There's a Greek. Some of you guys know options. So there's a Greek called gamma. Gamma is the rate of change of delta, and delta is how the option moves relative to how the stock moves or how the index moves, right? So if any of you know calculus, it's the rate of change.
It's a derivative of it.
It's a derivative, yes.
Okay.
The gamma is the derivative of delta, right? Gamma gets super, super high in the last hour of trading. It's ridiculous. The last day, it's very ridiculous. The last, week, it's bad. You got to go out like at least 30 days for gamma to be sort of reasonable. So it's much more, but I mean, there are plenty of people who do what they call zero DTE trades, meaning they expire the day of. There's a big world of people doing that right now. What happens is they get 3 or 4 winning trades in a row, they brag about it to everybody, and then you stop hearing about it, right? So you do the math. No, there are people who can do it successfully, but you can't just do neutral trades. You have to have some sense of direction. You have to be pretty good at calling market direction. Then you can make really good money doing that, actually.
So would you say the current market environment, since we're a little bit like, would a mean reverting environment be good for this call credit spread?
Well, I showed you an example, right?
Yeah.
That 2017, the VIX had actually gone down to 8 at one point. I think it broke the record. Okay, that's horrible for this kind of thing because you're getting tiny reward, same risk. That's why you could multiply by 20. This is a great environment for these kind of
Currently.
things. Yeah.
Okay.
So on the less volatile environment, like what option strategies would work?
Well, in theory, the better strategies in those environments are what they call calendar spreads, or it's where there are certain option spread trades that benefit from volatility. They're okay. I'd have to get really deep into theory to explain why, but in low volatility environment, you want to do trades where your short is in the front month and your long is in the back month or back week, or wherever you're going to put it.
Yeah.
And that because those will actually volatility will help the profitability on those trades. But trades where all your options are in the same expiration chain like these, well, this is only a one-day trade, so it doesn't matter that much. But if this was like a 60-day trade, you'd see massive swings in the P&L on the trade based on what's going on with the VIX.
Yeah.
So most of my trades are what they call negative vega, meaning they all the options are in the same chain, and so my trades I can almost tell you what's going on with the VIX just from looking at my P&L most days. They're unrealized gains, so they're not that important. But if I get this giant increase in P&L one day, it's because the VIX is going down in most cases, like a dramatic drop in VIX. It doesn't mean I'm ready to get out of the trade. I could have been down a lot money before that day and just a little by the end of that day. So it's not really making decisions for me, but it just does explain these big swings in P&L, which some people get very annoyed with, but they're not particularly real.